just want to do a quick video today. I've done a couple of videos in the past about the subject of annuities. Annuities are a hot topic in the financial services industry. They get some bad rap for, I think some good reasons at times, but I think there's definitely a place for them. And so I wanted to discuss the topic. I do get some questions about the topic of fixed annuities. I'd done a video previously about the two different type of annuities. Basically, you have like what they call deferred annuities, where I'm saving that money for some future use, and then you also have income annuities, where I'm receiving a paycheck, perhaps for a period of time, perhaps it's for the rest of my life. And so what I really wanted to focus on today is the topic of fixed deferred annuities. And so those are they're very safe investments. They're kind of like if you're a candidate to buy like a CD at the local bank or something like that, you might want to consider a fixed annuity. The fixed annuities are not FDIC insured, and so you can't really make a true comparison to a CD that's a bank product and it has FDIC insurance, but they're very safe. Typically, they're issued by an insurance company. Not typically, they are. Fixed annuities are issued by an insurance company. They basically take your money in and give you a guaranteed rate. What I've seen in my career are usually like 3, 5, or 7-year contracts, and it's just simply a guaranteed rate for a fixed period of time. And so, let's say that you got a 5% rate on a fixed annuity. That might be better than what you can get for a CD at the bank. You just have to kind of compare and contrast those. There's some big differences though. With a fixed annuity, they're typically sold by agents, licensed insurance agents who receive some type of commission for selling it to you, most likely. And so you basically have to stay in it for that period of time. So let's say it's a 5-year contract and you're getting 5%. Well, the good news is they're going to pay you that guaranteed rate of interest for a period of 5 years. And a couple things that happen if you comparing it to a CD. Let's say you bought a CD in a brokerage account or at the bank. Typically, the interest you get from a CD does not reinvest. It's just paid to like a money market or something like that, but that interest does not reinvest. With a fixed annuity, you get paid all along the way, and that interest reinvests and compounds. So the power of compounding can be a really good one. Also, there is some liquidity involved. Typically, a fixed annuity, you can take out 10% a year without any kind of penalties. And so, if you needed some cash, at least 10%, or maybe it's a scenario where maybe you bought at a fairly low rate and rates are increasing, at least you could take out your 10% a year without any penalties, and you can reinvest it at some higher rate. Typically, at the end of the contract, it's pretty straightforward. You get a notification. Hey, you have a annuity that's coming due here in a couple months. What would you like to do with the money? And so, so your choices would be: I could just cash the contract in, and you could do something different with it. Maybe if you said, let's say it's an IRA. I like to use IRA money the best, because I think you don't have to worry about the taxes because it's in this tax deferred umbrella that the IRA provides for. And so what you could say is, at the end of the contract, hey, that was great. I got my fixed rate of interest, but I think I'd rather put it back in my regular IRA and buy a mutual fund or a stock or something else. Or you could say, I like that. Let's look for another fixed annuity rate. And so as long as you don't take money out of the contract, like a withdrawal for yourself, there's no taxes involved. So I think that really works good. If you're using non-IRA money, then you have a little bit of a decision to make. You could cash in the contract and you could pay tax on the earnings at the end of the contract. Or you could do what's called a 1035 exchange. That's kind of like doing a rollover from one annuity to another. And that way there's no taxes involved. You're just kind of continuing to defer those taxes for some later date. And so, I think those are some pretty good options. And so if you're looking for a fixed rate, CDs, treasuries, those are the highest quality, fixed income instruments you can buy just about. And but sometimes the rates are a little bit better with a fixed annuity because they're not FDIC insured. They're not guaranteed by the federal government. And so it's only as good as the insurance company that's backing up the contract. So you have to be careful. There's a whole rating systems for insurance companies that rate them, what their financial strength is, their balance sheet, etc. And so I think this can be a useful tool. So I think in practical use, I did a video not too long ago just about what we call the anchor strategy, where maybe I take part of my money and I invest it in something very safe like a fixed annuity, and I take part of my money and I try to grow it aggressively. And so it depends on the proportions that you use, but I was describing in a video called the Anchor strategy, where you can basically give yourself principal protection for the safe part, and then you can take some risk with a small part of the portfolio. And so I think a practical use, again, is, if there's a portion of your portfolio you want to keep very safe, like let's say you have an IRA, you've been saving it for 30 40 years during your career, and I want to keep some of it safe. Like right now it's February of 2024, we have some pretty good fixed rates. They've been on the decline a bit in anticipation of the Fed lowering interest rates at some point, but they're still pretty good. And so historically speaking, so if you said, hey, I want to take a portion of my portfolio, keep it very safe, I think 5% is a pretty good rate. I'm willing to do that for 3, 5, or 7 years, or you could even ladder them. That works too. That might give you some peace of mind, and you can guarantee a good rate for a fixed period of time. So there's really no right or wrong way to use them. I just think if you want some safety, you want the interest to reinvest and compound, you want a little bit of liquidity, and it's not a lifetime commitment. It's like I said, 3, 5, or 7 years. I think you should consider that. So I would definitely talk to an expert who's got experience handling that. I definitely would go to somebody who knows what the heck they're talking about. I wouldn't just trust my life savings to somebody who just passed their insurance exam. That's not what I would do. So anyway, if you have any questions, my contact information is in the About section of my YouTube channel. Please like my video. And if you like the content that you're seeing here, please subscribe to it. And thanks for watching my video.